Good morning and welcome to 3 Minutes on Markets and Money. I'm your host, Lance Roberts, talking about buy the dip. As we have seen here repeatedly over the last several months, every time the market has tested the 50-day moving average, investors have showed up to buy the dip. Of course, this is because investors fear missing out on the rally because the Federal Reserve is still doing $120 billion in QE every month. And every time the market dips, again, the idea is that I want to make sure and catch this rally in the markets. Now, importantly, though, each of these dips have had a same repetitive pattern. We touch the 50-day moving average, we bounce up, trend sideways, basically not really going much of anywhere, dip again, rally, don't go much of anywhere. I've literally just kind of done a stair-step process ever since the November lows. Now, the interesting thing on Friday was market showed up, bought the 40-day moving average. Now investors are trained to not even wait for the 50-day. We've got to get in there early. Now, importantly, a few things here to look for. Money flow signals remain in place, suggesting that upside remains limited in the markets. Money flows themselves are getting weaker here. Watch volumes, though, because big volume spike on the sell side, not so much on the buy side. In fact, volumes are drying up pretty quickly as the market rallies here. Again, MACD sell signal still in place as well, all suggesting that upside remains somewhat limited. I suspect markets could very well make new highs here. But again, very much like we've seen every process here so far, if you didn't actually buy the dip, there's really not a lot of upside once that dip reverses because, again, once you make new highs here, markets kind of stall, stagnate, and go sideways here until the next decline. The important thing here is at some point, we are going to have a violation of the 50-day moving average. We are going to retest the 200-day moving average. That's about a 10% decline from this level. When that occurs, who knows? Importantly, what caused the rally on Thursday and Friday was basically Fed Reserve coming out saying, well, we might have to rethink that whole taper idea. I know we talked about it early last week, which caused the sell-off. And after the markets declined almost 2%, the Fed panicked and said, well, maybe we'll rethink the whole taper thing. That, of course, giving the markets a little bit of support here near term. The real problem for the Fed going forward is that economic growth is slowing. We're seeing more and more deviations between what's happening. As we discussed this morning on the Real Investment Show, there is a big gap between what's happening with monetary policy and consumer confidence. That linkage between monetary policy and consumer confidence now appears to be broken. So the Fed has more problems coming up. Markets here still extremely extended, overvalued, exceptionally bullish, and have had an exceptionally long period of time without a correction of any magnitude. All suggest that one could come up and kind of bite you pretty quick if you're not careful. So make sure and manage your risk. Watch your exposures here. But again, remain long for now because, look, the bullish bias is in place. The Fed is still doing QE. But what could change all that? That would be a change in taper. We could see that from the Fed in September. But we'll just deal with that when we get there. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. We'll see you back here tomorrow.